Right now, the session is being recorded. All right. So the first point that you're going to discuss today is what Coach alluded to as a small break. Basically, there are three types of breaks. So you can have a small break where, if you take a look at this market, this is the picture that I took from the chart, and I'll show you this particular example also in the chart. The market has been moving. Basically, we have three impulses. So the market was moving like this, and I have drawn a line graph so that you're able to follow how the market is going, because sometimes it's difficult to follow the candles. So the market was going like this. It formed a low. Then it went up. It formed a high. Now it's a counter trend. So meaning the end of this first impulse, what we're calling impulse A. Then it came down. It came down. Basically a pullback. So this is an uptrend. So the market generally is going up. So then the market broke this high, formed a new impulse. That is what we're calling impulse B. But notice that the impulse B, is getting smaller. Meaning, if you just take a keen look, this market, although is an uptrend, we are losing momentum. And this is what is called ascending. So although we are still breaking, going up, but the strength of the momentum is not as strong as down here. As you can see, look at this. Look at the way these candles look healthy. And then as you go up, they are looking smaller and smaller with big wicks. So although we are creating new highs, we are pulling back, meaning we are losing momentum. So you start seeing telltale signs that we are ascending. And that is more apparent when you look at what I'm calling the third impulse, the highest impulse, which is marked by the current high and the current low, impulse C. Notice the way this candle broke up, which is signified here, but pulled back in. So the big part of the candle remained inside impulse B, the previous impulse. And this is confirmed by this second candle that also stayed, majority of it stayed inside impulse B. So normally when you see those, there's a very high probability that the market will turn like this. And that is now what is shown by this bearish candle that comes and breaks this low. So this is what is called a change in direction. So normally when we look at our trade, we look at three things. First, there has to be ascending. Ascending happens when the market is going up. So in this case, the ascending has been confirmed around here. Second, there has to be a confident change in direction. Confident change in direction. And in this case, yes, there's a confident change in direction. The market came and broke this low with a candle that does not have a wick at all. It's very clean. You can look at it. It just came and broke. So then what do we do when we see these two conditions that have been met perfectly? Then normally we look at the most recent low. Because now the market has changed, is going down, we are looking to sell. And when we are selling, we sell at the most recent lowest point that the market broke. In this case, is right here. So most of the time we will place a sell limit order here, because as I've shown in the green line, the market will go down and then it will come back. It will come back to tag your trade and then go down with you. So ordinarily that's what happens. All right. I'll show you more examples when we go to the charts. So the second type of break that you're going to look at today is what we call a mid-size break. So what And the characteristic, what we call, why it's called a mid-size break, you look at the break in relation to the part that crosses the line. So if you look at this candle, look at the part that crosses the line. It is not small, neither is it big. So it's just mid-size. It's in the middle. So mid-size break can have a wick. Like in this particular case, the market came and broke with a wick. So this is a downtrend. The market was going down, as you can see from this chart has been truncated. So the market was going down, and then at this point it broke going up. It broke going back upwards. So it came and broke here, but this candle that broke, this is what we call a mid-size break, but it has a wick. So if you look again at the line graph, this market was coming like this. And normally we read our candles from left to right. So this candle was coming like this, going like this, then it went all the way down. But notice what happens down here when it comes here. It forms a new low, but it pulls back almost immediately. So this is what is called a descending pattern. Because the market breaks down. Look at the size of that wick. Look at that, so huge. So basically, it went down, but it pulled back in, and the biggest chunk of that candle actually was spent inside impulse A, the previous impulse. So when you see that descending pattern where you're trying to go down, but you're spending time in the impulse before, know that the market will just turn and go back up. Very high probability. And that is exactly what happened here. So the market came and turned. So the descending pattern is confirmed here, which is this. That is condition number one for us to enter a trade. The second condition is a confident change in direction. In this case, a mid-size break with some wick. Then in that case, we are looking to buy because now the market has turned and now it's going up. So what we'll see, like it's depicted in this green line, the market will break. This is the breaking point. So we will place our order at the most recent high, the highest point before the market broke, which is right here. And then we will expect the market to come back, tag us in, and go with us into the new direction. The third type of break that will mostly come about is what you call a large break. Typically, it could be one large candle or several candles. Just think about if you are to place these candles together, then all of them will form something like this. You can imagine these candles if we have to place them together. So now if you consider this, of course, plus the wick, now it actually looks like a very big break. So normally when you see the candles together, you try to group them. So this is what is called a large break. Look at the portion that breaks. If you put all this, although they form in different hours, but it just tells you that there's a very big momentum going upwards. So all these candles put together form what is called a large break. The part that crosses the line is very big. It's gigantic. So that is what is called a big break. And a big break is allowed to have a wick as well. So normally what you do is, again, this market was, previously it was a downtrend, it was going down, but the market has broken, going up. So our order will be 2 pips, because it's a very big break, 2 pips above the most recent high, so that the market will come back, tag us in, and go with us into the new direction. However, these conditions, sometimes when you come across what we call a red zone, or sometimes when it breaks and the wick, this is what we call a wick, this line. If the wick is larger than the body of the candle, then do not enter a trade. That is what we're calling watchouts. So the example that I've given you today is this. This is a red zone. So typically what happens in a red zone, the market keeps bouncing around a particular area. like in this particular case, this was actually taken this week. The market has just been ping-ponging between this area. So normally you can still take a trade here, but for you to take a trade, and as you can see, we try to take a trade here, the break must be very large. It has to be a very large break. As you can see in this particular case, look at the part that crossed where we are trying to put the break. This, and this. If you add all this, then it's a big, very large break. So if you come across an area where the market is in consolidation, I think that's the term that most of us are used to, and you see those conditions ascending, then a turn in direction, you only place a trade if the break is exceptionally large. Otherwise, if it's just a small break or a mid-sized break, then that I showed you before, you stay away. The other time you stay away from the market is if you are descending, like in this particular case, we are descending, and then the market comes and turns, but it doesn't turn confidently. This is a turn, the market has turned, but look at this. The wick of this line is bigger than in fact, the body of the candle stays inside the previous number. So this is what we call a rejection. So the only time you get involved with this type of a break, so we have changed direction, yes, but this is not a confident change in direction. We are not confident that the market wants to continue in the new direction that has changed. So ordinarily what you'd expect is the second candle to come and fill this rejection confidence. But look what happens to this second candle. Although it fills the rejection, it also forms a very big wick. So these two candles put together, these are rejection. So you stay away from this type of break. Most of the time, what will happen? The market will start going into consolidation. It will just ping pong around this area. And this you can also see, if you eyeball it, there's a lot of rejection up and there's also a lot of rejection down. So basically there's a rejection down and rejection up. Normally when you see pressure up and pressure down, the market is just about to start ranging. So, and going into a red zone. So the only time you get involved is this break has to be exceptionally large. All right, so now we're going to jump straight into our charts. I'll show you the 3 types of examples, and then we'll open it up for question and answer. Okay. So the first example you're going to look at is a small break with no wick. So as you can see, this market is going up. But as it's going up, we are starting to see signs of ascending because the candles are breaking, but they're coming back into the previous impact. They're breaking, they're forming new highs, but they're coming back into the previous impact. So what we expect in this particular market is for the market to turn going down. So let's see what happens. Then bang. You see the bearish candle, it comes and breaks this current low. So this is a valid setup. The market has been ascending. As you can see over here, this candle broke up, but it has spent a lot of time in the previous impulse, which is also confirmed by this second candle. And then this one now comes and changes direction by breaking this current low. So then what we'll do is we proceed to mark our high and low points like this. We just basically move them. So the highest point for this new impulse is right here. And this becomes the previous high. And this becomes the previous low. So then, because the market has broken going down, what we would expect to put here is a sell at the most recent or the lowest point, which is right here. So we come here on our tools, and basically we put a short position right here at 0.72657. So right there. Zero point 0.272,657. That's our entry point. Entry point 0.72657. So depending on your test and your back testing, you put the stop loss that depending on your risk appetite. So in my particular case, I usually put 14 pips. And then we see how the market takes us from there. So our trade is set. Let's see what happens. So the market comes here, as you can see from this, we are tagged in. We are tagged in by this green candle. It comes and tags us in. So we are in the trade. Let's see what happens. Then we start going down. So now we are in profit. So as we keep going down, our profit now is increasing. And I'll show you the second part on how do you manage your trade? How do you keep moving a stop loss as the market keeps going down? Let me zoom out a little bit. I think I zoomed in too much. So that you're able to see. All right. Okay, so we keep going down, until we get a counter trend. So we mark our lowest point. So for this, but at this particular moment, our profit is down all the way here. We are at about 3% of our initial capital in profit, but we don't move our stop loss yet until we encounter a counter trend. Basically, we form a new impulse. So ordinarily, we will secure our trade by putting the stop loss 2 pips above the highest point of the new impulse. And I'll show you. So we get a new impulse here, as you can see. The market has broken down. So this is the new low, this is the new high. So we move our trade 2 pips above this point, which will be 0.72349. 0.72349. 0.723. No, there's point 0.72444. 0.72444. So if I extend it like this, you see that my trade This is the highest point. My trade is just 2 pips above. So as the market keeps taking you down, you keep moving with it. So at this moment, we have secured already 1.5%. Although technically the profit is all the way down here, but the one that we have secured based on this trading plan. And at this moment, you can even go to sleep and leave your trade running, because you know that no matter what happens, if the market comes and turns against you, this profit is already secured. But if the market keeps going down, then you also keep pushing this. You also keep adjusting this. So it's almost like a trailing stop loss. You keep adjusting this so that you secure more profit. All right, quickly, I'm going to show you the second example. So the second example is a mid-sized break with a small wick. As you can see over here, we are in a big trend. We're in a big downtrend. The market is coming down, but over here we start descending. So we break down, but look at this candle. It spends all of its time in this previous impulse. So ordinarily what we expect is the market to come and break this current high. So let's see what happens. Bang, there we go. So this candle comes and breaks, but look, it's not a very big break. It's a mid-sized break, but it has a wick. So then what do? We place our order at the most recent high. It should be a buy. It will be a buy because now the market has started going up, but it will be at the highest point of where the market has broken, which is 0.76214. Right about here. So our entry is 0.76214, as you can see. And our stop loss, as usual, is 14 pips. And then we see what happens. So we have about 10 minutes to the end of this. So I'll finish this example very fast, show you the third example, and then we can jump into question and answer in the next session. All right, so let's see what happens. The market comes and we are tagged in by this orange candle that forms a very big wick on the downside. So similar to the other one, the trade management is the same. So we'll get a chance to move. Let me zoom out a little so that you're able to see. So this candle right here takes us into the trade. So right now, our profit is all the way up here, where the market has reached. But the only profit we are able to secure is when we get a counter trend, which actually happens right here. As you can see, the market has come and then there's a counter trend. So ordinarily what we'll do is we'll mark our new high point. And of course our low is down there. And then now we will mark our new impulse, which is right there. And the lowest point of this new impulse is right here. So to secure our trade, we put it 2 pips below this point, which in this case would be 0.76358. If you remove 2 pips, it's 0.76338. 0.76338. So all this green part is profit that is already secured. If the market comes and turns against us, this profit is already done. But as the market keeps going up, if it forms a new impulse, we keep moving our profit 2 pips below the lowest point of the new impulse. All right. The third and final example is a big break, which I'm going to show you shortly. All right. So similar to the first two breaks that you have seen, we keep looking for those three conditions. Look for an ascending or a descending pattern, confident change in direction, and then we place our trade at the most recent high if we are buying, or most recent low if we are selling. So let's look at what happened in this particular case. The market was going down, as you can see. We're going down because we are coming from here, going down. And then right about here, we are actually descending because look, we broke down but stayed back in. Look at this second candle, it came back to this previous impulse. So this is a descending pattern. So we expect the market to break up. So let's see whether this market is going to be able to break up. So first it tries to break up. This is what we call a rejection. So one rejection is okay, as you can see that way. So ordinarily what we would expect is for this rejection to get filled. And if it gets filled confidently, then we are in. So let's see what happens. It gets filled and it would feel bigger. So this is now what is called a big break. And bam. So the break ends there. So ordinarily what we'll do in this particular case, because it's a big break, it's a large break, our entry will be 2 pips above the most recent high. And in this case, the most recent high is this candle that you're seeing here. So it will be 2 pips above here, which will be 0.73046, 0.73046. So you come here, put a buy. .73046. Our stop loss as usual is 14 pips. And then now we just do trade management. So let's see what happens. So the market goes up. So actually this is the end of this impulse. And it comes and tags us in right here, as you can see. Oh, not yet. It tags in when it crosses this line, the line that separates the green and the orange. Yeah, so we are tagged in right here. And then the market just turns and goes up and up. So ordinarily, again, we get to move our trade in terms of profit when we see a new impulse. In this particular case, as you can see, we have a new impulse here. So there's a new impulse which ends down here. This is the lowest point. So we get to move our first profit 2 pips below this, which is 0.73072. 0.73072. Yes, so it's 2 pips below this point, and we keep moving it as the market keeps giving us more profits. Let's see what happens here. As you can see, the market went up again, And right here over here, we formed a new impulse again. So we mark our highest point. This is the end of this impulse. And this impulse starts all the way down here. So again, we move our profit 2 pips below this lowest point, which will be 0.73324. 0.73324. And so on and so forth. So this is how you do your trade management. As you get new impulse, you keep moving, you keep moving, you keep moving. Some trades are good, can give you as much as 10, 15, or even 20%. Some give you 1%, some give you 3%, depending on how the market is moving. So I would like to show you one more thing. This is based on the assignment that you are doing. And then now in the next round, we're going to open it up for question and answer. So this is the assignment you are supposed to do the week of the 12th to the week of the 12th to 16th July, the part that we gave you. So there are some opportunities that you are supposed to identify. I'm just going to show you a screenshot. You can mark them, and then later on you can see where the opportunities were supposed to be marked based on your back testing. So if you go back to the week that we gave you, this is how the market was going. The market started coming from here. There's a lot of change of direction. So there's first opportunity that you will get, although it ends in a small loss, about 0.07%. This one. And then you'll notice another opportunity right after it that ends in a very big profit, and a third one, and so on and so forth. So this is what you are supposed to get on that the week that you've been giving you, the week that you've been doing